Hello, this is John Burke. I'm delivering the course on international banking at Resebe University. And as I mentioned in my last lecture, today I'm going to talk about the case of Sri Lanka. Sri Lanka, as I said, is a country that has invariably been in financial difficulties ever since its independence in 1948. And it is presently on its 17th structural reform program under the IMF. So during the period from 1965 to 2020, Sri Lanka entered into 16 different structural reform programs with the IMF. And what does this mean, essentially? It means they had to seek IMF funding to get themselves out of financial difficulty. And what you have to realize is that when the IMF does lend money, during the period of the credit facility, they conduct an annual evaluation of how the country is doing. And at the time of closure, they must sign off and say that, well, your country has succeeded within this program and everything looks good to us. So this raises the question, how can the IMF have signed off in 2020 that everything looked good to them? And in 2022, Sri Lanka is back to the IMF asking for the 17th bailout. So I'll try to explain some of the factors that led to the most recent crisis. And I think countries like Sri Lanka are always vulnerable to many what you would call mismanaged internal policies and external shocks over which they have no control, and can find themselves in a difficult situation that requires them to go to the IMF. So what happened in 2022? All right, well, first, there are two long-term trends. Number one is Sri Lanka tends to run persistent fiscal deficits. What does this mean? It means that the government is spending more money than it takes in resources. When this happens, of course, what does it mean? Well, the difference has to be covered by borrowing. This can be both domestic and foreign. In Sri Lanka's case, this happened to take the form of a large percent of foreign borrowing. And this is one of the difficulties, because when you borrow in a country like Sri Lanka, which does not have a reserve currency, it has the Sri Lankan rupee. When you borrow money in the credit markets, these loans are going to be denominated in a different currency, most likely the euro and the dollar. And when you run persistent deficits that require persistent borrowing or the rolling over or restructuring of debt or refinancing of the debt, the total debt increases over time. That's factor number one. Factor number two, they also tend to run what is called a current account deficit. So what is a current account deficit? This simply means that it's part of the balance of payment statistics, and it's measuring what a country does vis-a-vis the rest of the world. And when you have a current account deficit, we're trying to find out basically, not completely, because it's a little more complex than this, is what is a country's ratio between exports and imports? Well, in the case of Sri Lanka, in running persistent current account deficits, they are importing more goods than they are selling to the rest of the world. Again, they are incurring a debt. In a way, they are living beyond their means. So this has to be covered by something else. So what is it covered by? Well, as you may guess from the term balance of payments, it must balance out. In fact, theoretically, it should go to zero. So the current account is just one facet of the balance of payments statement, and another major account is the capital account, and sometimes this is divided into two parts, financial and capital. But what essentially it means that capital from the rest of the world would flow into Sri Lanka to balance out the current account deficit. So how can it flow into Sri Lanka? Well, investors may purchase assets in Sri Lanka. Foreign investors may invest in Sri Lanka, or foreign investors lend into Sri Lanka. So these would be the three principal activities of capital inflow into the country. And of course, this may require Sri Lanka to allow repatriation of profits from assets that may be owned or investments that be made by the rest of the world. And of course, if it's in the form of debt, it has to be repaid. Again, like many economists will tell you, it doesn't make a difference whether you have a current account deficit, a fiscal deficit, it doesn't matter. But they do tend to agree that persistent account deficits, fiscal account or whether current account, then it could result in a problem. And that's what happened in Sri Lanka. So it has a twin deficit problem. Also what happened, so we could say that let's return to their fiscal deficit. In slightly after 2020, a new government came in, and they came in on the promises of lowering taxes. Well, this is fine if you lower expenditures, but this is not what happened. So they lowered taxes quite substantially, and at the same time, they did not decrease spending. In fact, they increased spending. So they had a lower tax base, but larger government outlays. On top of that, they also implemented a policy that agriculture had to be organic. And they implemented this policy essentially overnight. So what kind of effect did this have upon the economy overall? Well, it was a very negative effect, because the agricultural sector, which used to provide a good source of exports and export income, suddenly found itself in the opposite position, that Sri Lanka had to import rice, where before this policy was implemented, it was the next exporter of rice. And it also affected their other main export, which was tea. So this also then reduced income that they would receive from the rest of the world by exporting their tea, exporting their rice, exporting their other agricultural products, because of this policy decision of going to completely organic farming. So they banned fertilizers, they banned pesticides. So this is, let's say, factor number 3. Factor number 4, the Ukraine-Russia conflict also had an effect upon them, because Ukraine and Russia were a provider, they were exporters to Sri Lanka of very essential products, some food, wheat, naturally energy in the form of petroleum and gas. And so Sri Lanka was in a position of having to pivot toward other countries to find substitute products, mainly India, but this came at a greater expense. So this was, let's say, the third factor. Another factor is Sri Lanka depended for hard currency upon tourism. But around 2020, as we know, COVID had a major impact, and it basically reduced tourism worldwide. And for Sri Lanka, it got hit particularly hard because tourism is a vital sector of their economy, and they lost income from this sector. Also, simultaneously with this, Sri Lanka does have political unrest, and there were violent incidents. It's called Easter Sunday, where there were attacks by terrorists or groups that are unhappy with the current government. And naturally, this had the effect of deterring tourists from visiting Sri Lanka. So we had COVID, plus we had the political unrest and violence. So these two factors combined also to reduce the income from the tourist sector. So we put all of these factors together, and it had a very negative effect on the economy. And a major effect was upon the global reserves that were held by the Central Bank of India, because they had to be exhausted in order to pay for Sri Lanka's imports that were denominated in hard currencies. And of course, they had to be used to repay foreign creditors, also with the debt denominated in the foreign currency. So early in 2022, the central bank is literally depleting its foreign currency reserves, and it got to a point where the bank simply had sufficient reserves perhaps to run the economy for 1 month or 2 months or 3 months. And what happened is Sri Lanka declared, we're not paying back our foreign creditors, we're going to default on the loans, and they sought IMF assistance. The IMF came in, they gave them a credit facility for a period of 4 years, and a loan in the amount of $3 billion. And of course, it's been some time now since 2022, and if you read the latest Article 4 report from the IMF, again, it's very positive. It goes on to say that, yes, Sri Lanka is taking the necessary steps to reform the economy, to make certain that stability is restored, that debt is restructured, that government expenditure is lowered, that the tax base is widened, and so on. And I encourage you to read the report, maybe not in full, but at least the executive summary and some parts of the report. I mean, they do qualify their statements, but very much it's a positive, very glowing report on the success of the reform program. But we have to take this with a grain of salt, since it's the 17th reform program. So the natural question is, and I'd have to look into this further, is why did the first 16 fail? I mean, this is 16 times going to the bank, and you can't correct your economy. And the bank is, like most banks, it does this due diligence. It supervises the debtor, and then signs off and gives you a clean, you could say, bill of health. But it's superficial, because how could it last for just this very ephemeral period of 2 years before another crisis hits Sri Lanka? So I just wanted to talk about this to show an example of how a country approaches the point of insolvency. As I said, nation states cannot go insolvent. They can't go into a trusteeship where they auction off your assets. But they can get into the same position as an ordinary debtor, where they don't have the funding to repay their debts as they become due, and that is the case of Sri Lanka. And of course, because Sri Lanka does not have a global reserve currency like the US or like the euro, they always are constantly borrowing in foreign currencies. So this exposes them to foreign exchange risk, and it also exposes them to what type of interest rate can they get in the credit markets. Given the history of Sri Lanka, you would imagine that in some cases, if they have to go to the what's called the non-concessional market, they're going to have to pay high rates because they have a bad credit profile. They don't pay back their debts. So a creditor, to account for this credit default risk, would be only willing to lend at a higher rate. So this is another problem that countries like Sri Lanka face when they go to the international debt markets, is what is the cost of the money to them over a period of time. And it can be very expensive. And then I can't say most of the money, but a significant portion of the money that you're generating, or the produce of your capital and labor, where is it going? It's not going to Sri Lanka. It's going to an institutional creditor. So it's not going to improve infrastructure, education, medicine, other things that would improve the level of living in Sri Lanka. It's going to repay banks. And if we look closely enough, we could see that in many instances, a significant portion of the IMF lending is made to satisfy foreign creditor demands, to make sure that those banks are repaid, perhaps not at on the terms that they originally lended, because the debt can be restructured, but the IMF loan, a significant part of that, or at least some part of that, is going to repay the international creditor. It's not an investment directly into the Sri Lankan economy. I may come back to this because it's an area that interests me, because many countries are in the same boat as Sri Lanka and always have to go to the foreign markets, borrow in a foreign currency. Their currencies are weak, they are small compared to the other currencies in the foreign exchange market, and unless the country has extremely wise management from an economic and political perspective, they can run into the difficulties such as Sri Lanka. And of course, what will be most interesting is to see at the end of the credit facility period what happens to Sri Lanka. Is it going to succeed and not go back to the IMF? Or how long can the economy last without another injection of an IMF loan? And of course, then a subsequent restructuring of its economy under IMF conditionality. So I'm going to end the lecture there for this morning, and I will post another lecture soon. Thank you for listening. Goodbye.